Investment strategy: dark winter before vaccine spring. In direct contradiction to the Fed's view that its emergency credit programs should be continued, outgoing Treasury Secretary Mnuchin surprised markets last week by declining to extend most of the Fed's 13.3 credit facilities beyond the end of the year. This negative surprise is taking place at exactly the wrong time, as investors are facing a rapidly darkening winter, with rising COVID-19 waves, an air pocket of economic weakness exacerbated by the disappointing lack of fiscal support in the US, and rising risks of a major default or bankruptcy which could negatively hit sentiment. If the COVID-19 surge or winter economic slowdown is much worse than what the market expects, or if there's a major surprise default or bankruptcy which triggers sharp risk-off sentiment, then we would see near-term volatility. Otherwise, it's more likely that the market would look through these near-term headwinds to the 2021 vaccine-driven recovery. In the event of market volatility, we believe that the Fed will be likely to expand asset purchases to support sentiment, safeguard normal market functioning, and sustain the economic recovery. As we've seen so many times since the global financial crisis, asset purchases ultimately boost risk asset prices. Bottom line, we will maintain a constructive stance through the near-term challenges and will be buyers in the event of a major dip. In equities, we prefer Asia, excluding Japan, which will benefit from further US dollar weakness ahead, and a resurgent Chinese economy which is leading global growth. In fixed income, we are underweight developed markets investment-grade bonds as we expect the yield curve to moderately steepen ahead. We are overweight emerging market high-yield bonds, particularly Asian high yield. Despite default rates rising from a low base as the Chinese government is selectively allowing weak companies to default, reduce moral hazard issues, we have a favorable long-term view on this asset class, which provides attractive carry. It's also a beneficiary of a weaker US dollar, a strong Chinese economic recovery, and the global search for yield, as rates are expected to stay ultra-low for a prolonged period.